do here. In ending index value divided by the beginning index value minus 1, or else ending minus beginning divided by beginning. So we discussed these things. You can use any of these two methods to calculate the rate of return, and based on that rate of return you will do the payment, you as in this ABC according to the example. So when we do the payment based on the rate of return, you know, the rate of return, that might be a loss as well. There will be negative percentages. We are in shares, in stock indices, we do not always get returns. Stock index එක පහළට ගිහින් තියනවා නම් කලින් වතාවට වඩා, කලින් අපි consider කරන period එකට වඩා එතකොට තියෙන return එකක් නෙමෙයි loss එකක්. Right? So if that is a loss, there will be a negative payment. That means that value will be paid by XYZ. S&P 5 based on the S&P, if the S&P payment of ABC is negative, like in this instance, it is a negative payment. In this instance, that means ABC is not going to pay, but he is going to receive. He is going to receive. So this is a special feature in equity swaps, which we do not see in other types of swaps. There are no negative payments in other types of swaps, but in equity swap, there are negative payments. Negative payment means you're not going to pay, but you will receive that amount from the counterparty. So this was the calculations that we did. So based on each party's payment, we will calculate the net cash flow. You can see here, ABC should pay to XYZ, and here XYZ should pay to ABC. So we have calculated the net cash flow of ABC. Therefore, ABC should pay, ABC will receive, ABC should pay, and ABC will receive. Right? So the basis of calculating the S&P payment is the rate of return of the stock index. Did we do this example? Yes or no? අපි මේ example එක කළාද? Hello? Yes or no? Did we do this or no?
No, is this the previous one? That table. This one we did. We did this one.
Okay, we discussed only one example on equity swaps, no?
Yeah.
Okay, so this is the second example. Assume ABC enters into an equity swap to pay the return on the S&P 500 total return index and receive a floating rate. In the previous example, it was a fixed rate. He agreed to receive a fixed rate, but here it's a floating rate. On the day the swap is arranged, the index is at 2710.55. The swap will call for payments every 90 days for a 360-day period. XYZ, the dealer, offers ABC 90 days LIBOR plus 1. It's not just LIBOR, but LIBOR plus 1%. LIBOR rate එකට 1% එකතු කරලා තමයි floating rate එක ගන්න. LIBOR plus 1% with payments calculated on the basis of 90 days divided by 360. The notional principal will be $25 million. S&P index records are stated in the table. So you are given the LIBOR rate, you are given the S&P total return index data. Information are available. So unlike in the previous situation, here we have floating rates. Earlier, XYZ payment was a fixed payment. because XYZ agreed on a fixed interest rate. But now it is a floating interest rate, and that is also LIBOR plus 1. So these are the LIBOR rates, but we agreed on the agreement for LIBOR plus 1%. Right? And remember, this is 90 days. The payments are made 90 days. So can you calculate the figures, or can you calculate the S&P payment of ABC and interest payment of XYZ in each of these periods? So this is the date of origination. 0 is the date of origination, first payment, second, third, fourth. So take 5 minutes and do the calculations and send me the net payment of ABC. Make a Roosevelt in figure one balance net payment of ABC.
Recording stopped.
Nobody has sent the answers. මම ඔයාලට කිව්වනේ මට සිලබස් කවර් කරන්න ඇති වෙන්න කල් තියෙනවා. මේ ඉන්නේ තුන්වෙනි ලෙසන් එකේ අන්තිම ස්ලයිඩ්ස් දෙක. තව ලෙසන්ස් දෙකයි තියෙන්නේ. ඒ නිසා ඕගොල්ලන් ආන්සර්ස් දෙන්න නැත්නම් එතනින් ඉස්සරහට මම කරන්නේ නැහැ ලෙසන් එක. What should be the net payment here? Okay, we'll go one by one. So this is easy. Interest payment, calculation of the interest payment is easy. It is already given. You know, on the zero date, on the origination, we are not going to pay any, or we are not going to do any payment.
Recording in progress.
So there will be no payment on the date of origination. First payment will take place here. So can someone tell me the interest payment at this point? What should be the interest payment here? Can you all hear me? So what is the interest payment here? So you know how to get it. Always you have to consider the previous period interest rate. So here, the previous period interest rate is 2.45 plus 1, 3.45. And for 90 days, 3.45 should be divided by, yes, how much? 4. Because this is 90 days, for 90 days. Or else that 360 divided by 90. So can you send me the correct answer, because I don't have a calculator with me today? I prefer if you can tell me the answers. .025 is the interest rate, and plus 1. That means 3.45. 0.3, 0.0345 is the interest rate. For 90 days should be divided by 4 into 25 million is the notional principal value. Yeah, so that will be 215,625. That is the correct answer. $215,625. How about the payment here? What should be the payment here? Same thing, to consider the previous period interest plus 1, and we are going to consider for 90 days. What is the payment? Right, 259,375. So I'm reading your answers. Others, let me know if you get a different answer. 259,375. How about the payment here? 3% plus 1, 4% for 90 days into 25 million. 250,000. How about here? What is the last payment? 268,750. Right. So these are the values, or these are the payments of XYZ. Then we have to calculate the payments of ABC. So when calculating the payments of ABC, we have to consider the rate of return. Earlier we had the LIBOR rate, so we considered LIBOR rate and calculated the payments. But here we are not given a rate, but we have the stock index. S&P index is there. Therefore, you have to calculate the rate of return. So what is the rate of return here? Right. So your friend says the payment is 501,282. So let's check how to calculate the rate of return. 2000. So the ending one is, ending index is 2,764.9. Beginning, that is 2,710. Therefore, what you have to do? Ending divided by beginning. 2,764.90 divided by 2,710.55 minus 1. That answer minus 1 will give you the rate of return. So that is 0.02005 as a percentage, 2.005. This into 25 million, that is 501,282. So that's correct. Next, what is the payment here? There's a negative one. So that is obvious. See, ending index is lower than the beginning index. Beginning index, it's like 2,764, but this is 2,653. So there is a negative value. A negative value of how much? Says 1,05,913. So the answer you all get? Yes. This is a negative payment. Negative payment, that means ABC should receive this. How about the next one? Calculate the next one. That should be a payment. It should be positive because you can see the index has gone up. It has increased. 1,427,750. Yes. How about the last payment? It's a negative one. Why? The index has decreased. That is 884,518. These are the payments. So now you can calculate the net payment. Here, ABC should pay because XYZ's payment is lower than ABC's payment. Therefore, the net should be paid by ABC. Here you can see it's a negative payment. That means ABC should receive. May values දෙකේම එකතු ABC ට ලැබෙන්න ඕනේ. Here, is that 4 million? 1 million. No? Okay, so here it's a payment to ABC, as in the payment should be made by ABC because his payment is greater than XYZ, and here that is negative, which means XYZ should pay to ABC. Right, so you can see the answers here. Let me know if this is clear. Do you know how to calculate the net payments of net payments in equity stocks? If not, please let me know because this is the last example that we are going to discuss. So if you were given both the parties are paying based on stock indices, so nothing to worry. You have to calculate the rate of return separately and calculate the payments. මේ වගේම තව payment එකක් එයි. There will be no interest payment, but the payment will be made on the stock index. Let me know if this is clear. Okay, I assume it's clear because no one is responding. And it's easy to assume that it's clear. Right, so we are moving on to the next part, that is commodity swaps. So a commodity swap, it's a contract where counterparties agree to exchange cash flows that are determined on the basis of commodity prices. So here, the cash flows will be exchanged on the basis of commodity prices. So that we called as commodity swaps. So most commodity swaps based on fixed for floating swaps. It means one party agrees to pay a fixed price and for a notional principal amount of the commodity, and the other party agrees to pay a floating price. So there is an example for you to understand this. Consider a commodity swap involving a notional principal of 100,000 barrels of crude oil. One party agrees to make fixed semi-annual payment at a fixed price of $21 per barrel and receive floating payments in terms of dollar, right? So it's like this. So one party agrees for a fixed payment, right? There are 100,000 barrels of crude oil. That is the commodity in this swap. And one party agrees to pay fixed semi-annual payment for a fixed price of 21 per barrel. එකෙනෙක් කියන අර කලින් fixed interest rate වගේ මේ වෙලාවේදී අපි barrel එකක price එක තමයි fixed කරන්නේ. So we say $21 per barrel. And the other party will pay a floating payment. So how does it work? On the settlement, on the first settlement date, because this is a semi-annual one, on the first settlement date, if the spot price of crude oil, floating rate is the market price. So earlier also floating interest rate is the LIBOR rate, market interest rate. So one party agrees for the fixed price, which is $21. The other party says, I will agree for a floating price, which is the current market price. So on the first settlement date, if the spot price of crude oil is $20.46 per barrel, the pay fixed party must pay. That means the party that agreed to pay fixed, right? The party agreed to pay fixed should pay $21 per barrel into 100,000 barrels. The pay fixed party also receives. That means the party who agrees to pay fixed will receive a floating rate. එයාට හම්බ වෙනවා floating payment එක $20.46 into 100 balance. So finally net payment will be the difference between these two, which is $54,000. Right? So it is very easy. It's like this. You will agree for a price. You say $21. And the other party says, I will pay the market value or the floating rate. So on the date of the settlement, the current market price is 20.46. That means simply you lose. ඔයා 21ක් දෙන්න පොරොන්දුනා හැබැයි දැන් තියෙන්නේ 20.4. එතකොට ඔයා වැඩිපුර ගෙවන්න ඕනේ. Right? Because you agreed to pay more. The other party's value, the floating or the spot market price is lower. So simply you have to pay the net value. Right? Commodity swaps. So remember the specialty in commodity swap is we are agreeing on commodity prices. So one party will agree for a fixed commodity price while the other party will agree for a floating commodity price. For the floating commodity price, which is the spot market price. So on the date of the settlement, the net payment will be settled. That is commodity swaps. Then credit risk. In swaps, there is credit risk, right? There is credit risk when we exchange the principal amount. So in in currency swaps, where we will exchange the principal amounts at the end of the period, at the end of the termination, we have to, at the termination, we have to exchange the cash flows. So there is credit risk. You know the meaning of credit risk. Credit risk means you will give away a loan and you will not be able to collect that back. That is we called as the credit risk. So credit risk is there if the other party goes default. If the other party was default or bankrupted, you will not be able to collect that cash flow. Please give me a second. Hello. Right. So we were in the credit risk. The credit risk means you will not be able to collect some money back. So in the swap agreements, there will be credit risk because in the termination, especially in an agreement like currency swaps, where you will exchange the principal values, at the termination, you will have to re-exchange the money. You will have to re-exchange the currency. So if the other party couldn't pay you back, then there is a credit risk. So there are techniques. There are techniques that you can use to manage this credit risk. Vehicles exist. Vehicles means techniques. So you can see here there are collateral, net-in agreement, credit derivatives, marking to market. So what do you mean by collateral? How collateral can manage the credit risk? Not only for swaps, even for loans, we are the banks are asking for collaterals, that is to manage the risk. So tell me how collaterals work. What is the meaning of a collateral and how it works in loans? Munasingha, are you there? Munasingha?
Yes, ma'am.
Okay, so can you tell me another term for collateral? So I got one answer, method of granting, verifying in order to reduce the credit risk. Okay. So Mona Singha, can you tell me another, like a similar word for collateral? So if I say this similar word, I'm sure you know the meaning of collateral. Madhuanti, are you there? Okay, that's correct. Guarantee. The collateral means a guarantee. So when you go for a bank, when you go to a bank to borrow a loan, they will ask for guarantee. So the collateral means like another term for this guarantee. So for currency, or to manage the credit risk, maybe in swap agreements or maybe in other ways, you can use collateral. Simply, you will ask for some asset, a security, right? You will ask for an asset, a security or something as a guarantee for this. So if the other party fails to pay you back, you can liquidate that asset and compensate your loss. So that is the purpose of a collateral. So for swaps also you can do this, especially in bank loans. If you have, like, if they are not satisfied with your financial level, what they'll do, they'll ask for a collateral. Sometimes they'll ask for you to keep a land as a collateral, and in case you are unable to pay back your loan, they will they will take your land. Bank එක ඔයාගේ ඉඩම පවර ගන්නවා. Then they will liquidate that land. ඒ land එක නැත්නම් ඒ housing loans දෙනකොට house එක collateral එකක් විදියට ගන්නවා. හදිසියෙ ගෙවන්න බැරි වුණොත් what they will do? Yes, they will sell the house and compensate for their loss, right? So collateral is something like a guarantee. For swaps also, to mitigate or to manage the credit risk, you can use collaterals. Then netting agreement. Does anyone have any idea what is a netting agreement? Netting. I think you are learning this in detail in international trade and finance subject. Netting. What is the meaning of netting agreement? Nobody knows. Okay, it's like this. We'll say there are two parties, A and B. Why don't we take two names? So we have Tharani and Chalani. Tharani Siripa dikhi මොනවද ගෙනාවේ? Exercise දුන්නාම ළමයි ඒවා ගණන් ගන්නේ නැහැ. සිරිපාද යනවා. ඊට පස්සේ කෝල් කර කර කියනවා පස්සේ සබ්මිට් කරන්න කියලා නේද? Okay, we have Tharani and Chalani. We'll say they have a swap agreement where they need to settle these amounts. And also they have, they have other contracts, agreements between them, where Tharani needs to pay Chalani 500 USD. Where Tharani needs to pay Chalani 500 USD. So netting is something like this. This is an example, right? So Tharani needs to pay Chalani 1000 USD. Chalani needs to pay 1500. So you can net. Simply Chalani needs to pay 500 USD to Tharani. So instead of Chalani paying 500 USDs to Tharani, or Tharani, they can net these two values, right? So Chalani will say, here Tharani, you have to, you are supposed to pay me 500 USD. So we will net these two values. So netting is something like this. So this happens in international trade, like in international financing, where the countries take loans. So when one country take loan from the other country, so it might go like this as well. We'll say there are three countries like A, B, and C. Yeah, right. I've got a definition for netting. Offsetting the value of multiple positions or payments due to be exchanged between two or more parties. It can be used to determine which party is owed remuneration in a multi-party agreement. Yes, very good. Very good, Madhuvanti. Right, so it is like this. There are three countries, A, B, and C. Right, A has to give B 100, C 150, and B has to give A 200, and C, let's say 50. C has to give, or C has to pay A 120 and B 200. Right? So see, you can net these agreements. ඔයගලන්ට මේවා net කරන්න පුළුවන්. How? First, see, A should pay B 100 and B should pay A 200. So simply, the net will be B don't need to pay anything to A. Sorry, A don't need to pay anything to B. මේක අපිට අයින් කරන්න පුළුවන්. And B will pay 100 to A. A B ට 100 ගෙවන්න තිබ්බා. B A ට 200 ගෙවන්න තියෙනවා. අපි කියනවා මේක අපි settle කරනවා. අවසානයේට B A ට ගෙවන්න ඕනේ 100 විතරයි. Right? A should pay C 150 and C should pay A 120. So we are going to settle this. So we say C don't need to pay anything to A. Instead, A will pay 30. This is netting. How about here? B should pay C 50 and C should pay B 200. So what we can do? B don't need to pay C anything. B C could give one, but C will pay 150. C will pay B 150. So we can further net this. මේක තවදුරටත් net කරන්න පුළුවන්. Like between the countries. So you will learn this in detail, but for your understanding, netting is something like this. When you have multiple agreements, you can net them. So if you have a swap agreement and also other agreements and other payments due, you can net them. That is we called as netting agreements. Then credit derivatives. What is a credit derivative? Can you search? Yes, a credit derivative. It's a contract whose value depends on the creditworthiness or a credit event experienced by the entity reference in the contract. Yes. So more answers. Yes. So credit derivatives are used to transfer the risk. That is correct. So in credit derivatives, one party will sell the risk and the other party will buy the risk. Right? Please search about these credit derivatives. There are different types of credit derivatives. So credit default swap is what we are referring under. Sorry, credit default swap is what we are referring under this credit risk. A credit derivative is a financial contract in which the underlying is a credit asset, debt, or fixed income instrument. The purpose of a credit derivative is to transfer credit risk and all or part of the income stream in relation to the borrower without transferring the asset itself. Yeah, so what I'm reading here is the answers that your friends have sent. Very good. So search about these things. Simply credit derivative. In credit derivative, it's selling the risk, right? Like in currency will be the underlying asset. So here the main aim is to transfer the risk to another party. Credit derivatives, there are different types. So one is credit default swaps. Search about that. Okay, then we have marking to market that you already know. We have done calculations, marking to market, which we practice in futures contracts, future margins. Marking to market means the daily settlement. When there are daily settlements, there will be no, the credit risk will be low. Not actually, we cannot say there will be no credit risk. But when there is marking to market, there will be daily settlement. So we don't need to wait until the end of the contract to get the gains or the losses. So identify gains or losses. So that is one way that we can manage the credit risk. So these are the different ways we can use to manage the credit risk, not only in swaps, but also in other credit agreements. You can use collaterals, you can use net-in agreements, and use credit derivatives and marking to market. So these are the different ways to manage the credit risk. So that is all about swap agreements. Right? So we are going to start the discussion on our next topic, which is options. So before moving to options, let me know if there's any difficult part or if there's anything you want to get clarified in swap agreements. If not, we will move to the options. So we had a briefing. We had a brief introduction in one of our previous lessons. Right, so an option. See, the option word itself says the meaning of this derivative. Option. What do you mean by an option? It's an option. That means it's not compulsory. When there are options, it's not compulsory. So you had two subjects, optional subjects. development economics and entrepreneurship and small business. So they are not compulsory. But financial derivatives, it is compulsory. So the option means you have, oh, it's not compulsory. You have alternative ways. So, and option is again a type of derivative and they are traded in securities exchanges. They are exchange traded derivative. Similar to other derivatives, they are also based on the value of underlying securities, such as stocks. And options will have a specific expiration by which the holder will exercise their option. Unlike futures, the holder is not required to buy or sell the asset if they choose not to. Remember this option or this buying or selling an asset, it's not compulsory. If they choose not to buy or sell it, they can, they don't need to do. But this is only for the option holder. There are two parties in a contract, in a derivative. So this option right will be given only to one party, which we called as the option holder, option buyer, right? Specialty in option is the holder, option holder is not required to buy or sell the asset if they choose not to. But remember, only one party will get this right. Right, so this is an option. We'll say Toyota is launching a car, price is rupees 5 million. You can book a car by paying rupees 50,000 deposit. By paying rupees 50,000 deposit, you are buying an option to buy this car. What if you don't want to buy the car? ඔයා ටික කාලයක් යනකොට හිතනවා Toyota car එකක් ගන්නෙ නෑ මම. What can you do? Is it compulsory to buy the car? Is it compulsory? Yes or no? No, it's not. How about the Toyota company? Should they sell you the car? Are they obliged to sell you the car? You book a car by paying rupees 50,000. The real price is 5 million. Now, when I asked whether it is compulsory to buy the car, you said no. How about the Toyota company? Are they obliged to sell you the car? Say yes or no. Okay, so we'll go for another example. You book a hotel for a function. Right, the function is on 31st December. On 31st December, you have a batch function and you book a hotel and you pay rupees 30,000. Right, you book a hotel and pays rupees 30,000. Right, then later you decide not to have that function. You decide not to have that function. So now what will happen? Since you booked the hotel, is it compulsory to have the function? Are you bound to have the function since you booked the hotel? Yes or no? So you booked a hotel to have a function on 31st December. You paid 30,000 to the hotel manager. Now, on 31st of December, is it compulsory to have the function? Can't you cancel the function? It's not compulsory. If you want, you can cancel the function. How about the hotel? How about the hotel? Can they cancel the function? Can they take another reservation?
Can't.
Can't. They can't. They can. ඕගොල්ලෝ hotel එකක් book කරනවා. ඒ දවසට function එකට යනකොට hotel එකේ වෙන function එකක්. එහෙම පුළුවන්ද? Huh? No, the hotel can't. Right? Okay, the hotel can't. That's correct. So you can see when you pay an advance, so you have a right. You have the right either to have the function or not. If you want, you can cancel it. The only thing is you will not get your advance back. Advance කරපු ගාන දෙන්නේ නැහැ. එච්චරයි. But you have option. You have option to have the function or not. But from the other side, from the seller side or the hotel side, they cannot take any other reservations for the same day. They have a responsibility. They have an obligation to give us the hotel. So option is also something like that. If you are the option buyer, you have the right to buy it, or you have the right to buy the asset through the option or not. If you don't want, you can say, I don't want this asset, and you can refrain from exercising this option. But the other party, the seller of the option will have an obligation to sell you the asset. එයාට කියන්න බෑ option එකේ මම ඔයාලට මේක විකුණන්නේ නැහැ. එහෙම කියන්න බෑ. That is the specialty in an option. Okay, so remember these examples. Right. So by looking the car, what you have bought, when booking matures, can Toyota force you to buy the car? No, Toyota can't force you to buy the car. That's your choice. Can you force Toyota to sell the car? Yes, you can force Toyota to sell the car because you have paid an advance and made a booking or a reservation for a car. Right? So the same thing that we discussed with the hotel example. Right? So remember, an option. In an option, it gives the buyer the right but not the obligation to buy your seller specified underline at a set price on or before a specified date. Now the speciality is this. Now option buyer and seller is different from the asset buyer and seller. Right? Option buyer and seller, it is different from the asset buyer and seller. Like this. So we'll say there is an asset. The car is there. Right? Now the car seller will write an option. Right? He will come and talk to you. There is a car seller, the person with the car, he comes and talk to you. I have a car and I'm willing to sell this car at 6 million rupees. At 6 million rupees on 25th February. Right? Car seller comes and talks to you. He says, I'm willing to sell my car for 6 million rupees on 25th of February. And he is asking whether you are like to buy this option. Now you agree. So in this situation, you are the option buyer. You are the option buyer, and car seller is the option seller, or we call him option writer. Right? So now here who has the right? Card the right එක තියෙන්නේ, card the obligation එක තියෙන්නේ. We'll use the word summon. Tell me who has the right and who has the obligation? Yes, very good. Someone has the right, car seller has an obligation. So simply, someone is the one who bought the option. So on 25th of February or on 24th, someone can tell the car seller, here, I don't want to buy your car. He has that right either to exercise or not. And car seller, he has an obligation to sell that car. We'll say on 24th February, right? On 24th February, the price of this car is 7 million. In the market price is 7 million. Right? Now, the market price is 7 million, but he agreed to sell you at 6 million. Now he cannot say, I don't want to sell you this car. Sorry, I don't want to sell you this car, but I can sell it in the market. He cannot say like that. He has an obligation to sell the car at 6 million if you ask for. ඔයා ඉල්ලුවොත් ඔයා කිව්වොත් ඔයා මේක exercise කරනවා කියලා car seller ඔයා කියන්නේ someone, right? Car seller has an obligation to sell the car to someone, and someone has a right to buy or not this car. එක්කයට ගන්න පුළුවන් නැත්නම් ගන්නේ නැතුව ඉන්න පුළුවන්. Now the other way around. Now someone goes to a car seller and say, I'm willing to buy your car at rupees 6 million on 25th of Feb. Right? Someone goes and talk with the car seller and he says, I'm willing to buy your car. Do you like to sell it? So in this situation, now someone is the one who tells the option, or someone is the one who offers. So in this situation, car seller is the option buyer and someone is the option seller or option writer. Option එක ලියන කෙනා. එහෙම නැත්නම් option එක විකුණන කෙනා. Right? So in this second scenario, who has the right and who has the obligation? Who has the right and who has the obligation? First situation, car seller went to someone and said, I'm willing to sell my car. Would you like to buy it? Someone said, okay. And someone was the option buyer and car seller was the option seller or the writer. Then in the next situation, someone goes and asks from car seller, I would like to buy your car. Would you like to sell it? So someone is the option seller and car seller is the option buyer. So in this situation, car seller has the right. What is the right? He can either sell it or not. On 25th February, car seller ට කියන්න පුළුවන් මං කැමති නෑ ඔයාට කාර් එක විකුණන්න. එහෙනම් එච්චරයි. Because he has the right. Someone has the obligation to buy this car. Market එකේ මිලට වඩා මේක වැඩි වුණත් someone ට මේකෙන් option එකෙන් ගන්න වෙනවා. So these are the two situations. That's why I told you here we are referring, the buyer means the one who buys the option. Seller means the one who writes the option, one who sells the option. Right? So this type of option we called as call option, and the second type we called it as a put option. First situation, that is a call option. Second situation is a put option. Right? So in any of these situations, option buyer will have the right and option seller will have an obligation. Right? So option buyer can decide either to buy or if it's a sell, either to sell. But when the option seller is having the obligation, maybe he has to buy it, or on the other side, maybe he has to sell it if the option buyer asks for. Right? And the underlying asset, it is the same thing that we discussed in the beginning of the lecture. So something that can be bought with the option is called the underlying asset. So in the previous example, car was the underlying asset. Right? And the strike price. Strike price means the price or the agreed price we called as the strike price. In the previous example, rupees 6 million is the strike price, right? Then strike prices are determined by the exchange and informed to the markets when an options contract is introduced. New strike price may be added every day by the exchange depending on the movement of the underlying asset price. Right, so these are the two types of options, call option and put option. Call option and put option. So in a call option gives the buyer of the option the right to buy. Call option gives the buyer of the option the right to buy. Right? So in a call option, buyer has right to buy the underlying asset. Seller has an obligation to sell the underlying asset. Right. And in the put option, right? So in the put option, the other way around, that is the buyer is given the right to sell. So we will discuss the put options later, but for your understanding, remember in call option, that will give a right to buy. Sorry, in call option, it will give a right to buy, but in put option, it will give a right to sell. So we discussed that in the summons example. So we will discuss call option in detail. A call options price, any options price, actually, we frequently refer to it as option premium. Option price, option is a separate thing. Underlying asset price is a different concept, and option price is a different concept. Here, option is it's a contract. So this price we called as option premium, right? The price of premium is paid by the holder to the writer of the option against the obligation undertaken. So normally, this option premium, this option price will be paid by the buyer of the option to the writer or the seller of the option. The buyer of an option needs to pay to the seller the price of the option, which is called the premium. It is paid immediately on buying the option and the seller receives the premium. So option buyer will pay the premium to the seller, right? The call writer might not own the underlying asset. The arrangement is referred to as a naked call, where the option writer, if the option writer does not own the asset, right? I don't have a car, but I will sell an option for a car. So in such a case, we called it as a naked call. If the owner of a call exercises option and if the exercise is assigned to a naked writer, the naked writer must buy the underlying asset at its prevailing market price and sell underlying asset at strike price. So what does that mean? So I write an option for a car, but I do not have a car. So that is a naked call. If the option buyer decides to exercise the option, කියන්නේ මගේ option එක ගත්ත කෙනා කියනවා මම ඔයාගේ car එක ගන්නවා මේ option එකේ strike price එකට. So what I have to do, if he says he is going to exercise this option, then I have to buy a car at the prevailing market price and sell it to the option buyer. මගේ ගාව asset එකක් නැතුව මම option එකක් ලියනවා. එතකොට counterparty option buyer එක exercise කරොත් මම කොහොම හරි asset එකක් purchase කරලා යාට විකුණන්න ඕනේ. An individual writes a naked call. Brokers will want a guarantee that the capital is available to buy the underlying asset. So when I write a naked call, I have to show them that I have enough funds to buy the asset if wanted. ඕනේ වුණොත් asset එක ගන්න, security එක ගන්න මගේ ගාව capital තියනවා කියලා මම guarantee වෙන්න ඕනේ, මම prove කරන්න ඕනේ. Right? So to prove this, there is margin requirement. There are margin requirement exist as a form of collateral, as a guarantee. I have to maintain a margin in my account. So when there are margins available in my account, so they know in case if I have to purchase the asset and sell to the buyer, I have enough funds. Call buyers hope that the price of the underlying asset will increase in value. So, for example, investor owns a call to buy 100 shares of IBM at a strike price of 120 per share. Then IBM share rise from 120 to 125 soon after the purchase of the purchase call. Simply, why I buy an option? There is an option for IBM share, right? The strike price is $120 per share. This is the option. Why I should buy this option? I should buy this option if I think this price will further increase. Right? If I'm buying this option, my option එක ගන්නෙ මම, the intention is to buy the shares through this option. The purpose of buying this option is to purchase shares through this option. So if I purchase shares through this option, I have to pay $120 per share. So why should I buy this? Because I expect the price will increase above 120. මං හිතනවා market price එක 120 වලට වැඩි වෙයි කියලා. Right, since I have this expectation, I will buy an option. So when I buy the option, even though the market price is 125, we'll say the market price was 125, I can exercise this option and buy the share at 120. So that is why we say buyer, a call buyer will hope, or the call buyer hope the underlying asset price will increase in future. That is the expectation, or that is why I will go for a call option. Right. Can you answer this question? So on December 15th, ABC Limited has a call option. Underlying price is 100. That this is the market price. Strike price is 80 and premium is 30. Right? Underlying price can be above or below strike price. So if the underlying price was 115, and if the underlying price was 95, and if the underlying price was 75, would you exercise the option or not? First, we'll go for the first option. If the underlying asset was 115, will you exercise this option or not? There's an option with a strike price of 80, premium 30, and underlying price is 115. Market price is 115. So will you exercise this option or not? You will exercise. Yes. Why? Because in the market it is 115, but you can buy the share at 80 through the call option. Next, will you exercise this option or not? When the market price is 95, will you exercise this? When the market price is 95, strike price is 80. You will still exercise that. That's correct. Then the market price is 75. Strike price is 80. Will you exercise this option? No, you will not. So remember, you will exercise an option when the market price is above the strike price. So when underlying closes at 95, when the underlying asset price is 95, the option buyer will receive 15 from seller, because strike price is 80 and underlying asset price is 95 in the market. When the underlying asset price is 115, the option buyer will receive 35 from the seller because strike price is 80. The agreed price is 80. Right, so this is we call the net payoff table. We are going to find the buyer's payoff. Strike price. Remember, strike price is denoted by K. Strike price is 80. And these are the different prices of underlying asset, 180, 160. So these are different prices. Payoff. Right, payoff is how to calculate it. So that is like this. When the underlying price is 180, the strike price, remember, that was 80. Therefore, payoff is 100. When the underlying price was 160, strike price was 80, again agreed price again 80. Therefore, we have a payoff of 80. So likewise, you can calculate the payoff. 40. Here 30. Here 10. Why we have nil here? Why there is no payoff? Because when the underlying price is 80, 70 and 50, he will not exercise this. He will not exercise this option. Rather, exercising the option at 80, he can buy the same underlying asset in the market at a price equal or below than 80. මේ 80 strike price එක 80. එතකොට agreed price එකට ගන්න ඕනේ නැහැ, market එකේ prices අඩුයි. That's why there is no payoff, because buyer has right. Buyer ට මෙතනින් පල්ලෙහා කියන්න පුළුවන් මම මේක exercise කරන්නේ නැහැ. Right? And the net payoff, remember, there was 30 rupee. There was 30 rupee premium. Premium is the price of call option, or price of an option we called as the premium. So from this payoff, or not from this payoff, actually we have to pay, even though we have a payoff or not, we anyway have to pay 30 to the seller. අපිට ගෙවන්න වෙනවා 30 rupees. We have to pay 30 rupees to the option seller. So every time we have to pay 30 rupees to the seller, because that is the premium. Even though we do not exercise the option, we have to pay the premium. අපිට exercise කරන්න නැතුව ඉන්න පුළුවන්, හැබැයි premium එක ගෙවන්න වෙනවා. Right, so this is our net payoff: 70, 50, 10, 0, negative 20, 30, 30 and 30. So we can get into the conclusion. That is, what is the conclusion? What can you say about the option buyer's profits and his losses? Yes, what is our conclusion regarding call option buyer's profits and his losses? What can you say? You can see the losses are limited to 30. See, the maximum loss of the call option buyer is 30. 30 is the premium. So you can say the maximum loss of call option buyer equals to the premium, or the price of the option. And the profits are unlimited. Profits are unlimited. Right? මෙහෙම උඩට යන්න පුළුවන්. Underlying price එක තවත් වැඩි වුණොත් profits තවත් වැඩි වෙනවා. But when it comes to the losses, that is constant. The losses are limited to 30. It is constant. It will not go beyond 30. So simply, our conclusion regarding the call option buyer's profit is it is unlimited, and his losses are limited to the premium. How about the other party? Yes. How about the other party? Seller's payoff, what you can say. So the opposite of this will be the seller's chart. This is a buyer's payoff. Remember this one. Maintain a buyer net payoff. Sorry, buyer payoff. And here we have the seller's payoff. What can you say about the seller's payoff? That will be the opposite of buyer, which is option sellers. Option sellers, profits will be limited to the premium and losses will be unlimited. May negatives enna වැඩි වෙන්න පුළුවන්. But the profits will be limited to the premium. Right, so those are the two conclusions about option buyer and sellers profits and losses. Option buyer, unlimited profits and limited losses. Losses will be limited to the premium. Option seller, unlimited losses and limited profits. Profits will be limited to the premium. Right? So if you draw a graph, we can identify that in detail. We will draw the graph and discuss this in detail along with the put option this Wednesday. Okay. So if you have any questions regarding what we have discussed so far, you can ask. And I will upload the swap slides onto the VLE and I'll try my best to upload the recordings as soon as possible. We'll see if the VLE is working now.
Recording stopped.
Do you have any questions? If not, we will wind up for the day and we'll see you this Wednesday. Have a good evening, everyone.